Good morning. The last video, we talked about the moving averages, moving average crosses as setups to look for opportunities to buy a stock. We didn't talk about exactly when to get in or exactly when to get out of a trade. And I showed you a Japanese candlestick chart like this one, but we didn't really talk about the basics of candlesticks. So I'd like to start there because that's critical to the next strategy that I want to show you, is that you at least understand just the very basics of what these candles are. So let's go over here to Investopedia, and they have just a simple drawing here that explains the parts of a candlestick and how you would read it. You have a body and you have a wick. It can be an upper wick, a lower wick, or both. And the candles will be a color. Black and white are used on some charts, red and green on others, or you can change them to whatever colors you happen to like if you really want to play around with it, depending on the platform you're using, of course. But, if the body is black or red, it means that the stock closed lower than where it opened. The body being this portion here, if you can, you see that. The wicks are the highest price that this candle achieved, or the lowest price that the candle achieved. And depending on whether it's white or green, or not, excuse me, whether it's red or green, a red candle would be a down candle where the price opened here and closed down here, being lower. In the case of a green candle, the price opens down here and closes up here. So pretty simple, and really for the strategy that we're looking at, what we're concerned with is the body of the candles, the opening and closing prices. The wicks, they tell you other pieces of information, but in this strategy that I'm about to show you, it's not super important. So because Yahoo here is definitely not my favorite place to go for charting, I'm going to switch things up and I'm going to show you what I use, which is Thinkorswim by TD Ameritrade. This is probably the most versatile, the best, if you want to call it that, charting platform that's available out there for free. The only thing you have to do in order to have access to this is open an account with TD Ameritrade. You don't have to put any money in the account. So it doesn't have to be funded. You can get all this, and it won't be real-time data. It'll be delayed data, but it's only delayed by a few minutes. So depending on what kind of trading you do, it could suit your needs. For your school project, definitely this would be all you need. So anyway, let's put the indicators, the moving averages, back on the chart here. Okay, so here's the stack up that we talked about in the first video. The aqua colored line is the 9-period moving average, and this is a daily chart, so this is averaging the last 9 days. Each candle represents 1 day of trading. The green line is the 20-period moving average. The orange line is the 50. The blue line, I don't think we had in the first video. I don't think I put that, but it is the 100-day moving average. And then the red line is the 200-day. The chart we're looking at, this particular entity, is SPY. SPY is an ETF, an exchange-traded fund that represents the entire S&P 500. It's one of my favorite things to trade. and we'll talk more in depth about those at a later time. Um, but it demonstrates quite well what I want to show you here. So let's scroll back in time here a little bit. And what we're looking at right here is back. In fact, let me put something on here that'll help. I think put the data box in. Yeah. Okay. This is December of 19 up into February of 20. And if you remember back, this is coronavirus. They first started talking about it in November, December of 19. January, February, they started talking a whole lot more about it. And on February 20th, the market started to react. So you see, with the 9-period moving average, how on, I'm reading the dates from over here in case you didn't realize that, but on the 20th was it started with a red candle. On the 21st, the closing price, the bottom of the body of this red candle, closed below this 9-period moving average. And the strategy I'm talking about is called Ride the 9. So if you were already in a long trade, a long position in this particular stock where it had been going up for the past few months, this is your indication right here when it closed below the 9-period moving average that it's time to sell this stock, to get out of your position, take your profits, and leave. Or if you were going into a short position, in this case, this is the opportunity. And you'll see the 9-period on the very next day crosses over the 20-period and then continues where the 20 crosses over the 50 as the days go by, and the market is falling here. So if you were to go short the stock, which I'm not sure if your class is permitted to do that or not, but it's definitely a profitable way to trade at times if you get it right. And you can see that the stock price, every candle, is below this 9-period moving average till we get to this candle here. This green candle on this day was a bullish day. The following day was also a bullish day, but we're still below this 9-period moving average. Then we have another red day, and we come further down. The following day we did close above the 9-period moving average. So does that mean you should go long and reverse your position at this point? Not necessarily. Not necessarily. The moving averages are still stacked up on the downside. So then, the following days, stock price continues to go down. You do have some bullish days, but the overall trend is definitely in the downward direction until we get down here. Whereas on this day with these long wicks, the price did manage to close just above the 9. The following day, it closed quite a bit above the 9. Then we had a minor pullback, and it continued up. So that is real basic of what the Ride the 9 strategy is you're looking for consecutive closes or opens, either above or below this moving average line, that tell you when to get in, when to get out. Take your money and run. So if you follow it, like here, we got, if you got back in again, ride it all the way up here until it crosses back down again, and then sell your position, get out. Wait for the next opportunity to enter, which is over in here. This candle or this candle, and then ride it up again. It starts to pull back, closes here, so small profit. Here, after the pullback, we open above the 9, ride it up, continues. Here you have a decision area where it's closing right at the 9 or just barely under the 9. So you have to decide, are you going to stick it out, take your chances, ride it further, or is it going to pull back and go down? So it's all about reading the price action. All of these indicators that you'll see, no matter what platform you're looking at. Here's a list of indicators that I have in Thinkorswim. You can see this is an extensive, long list. Almost everything here is simply different ways of telling you the same thing. Different ways of measuring what price is doing. By doing that, almost everything works. It's called a lagging indicator, and that is almost everything that's available. It's telling you what has happened in the past. It doesn't tell you necessarily what's going to happen in the future. So, but that's very simple strategy. Again, in addition to the moving average crossover that I showed you in the last video. So, if you've got any questions about it, go ahead and ask me. So I'll see what I can do to help you out. So that's all I have at the moment. So I hope you have a great President's Day, and we'll see what the future holds for the market with everything that's going on in the world. So have a good day.